Good morning, everyone, and welcome to our Finance Focus webinar, where our panel of experts will be providing you with essential updates, highlighting the key implications and providing some insight and guidance by answering your questions. I'm Jennifer Williamson, a partner at Creston Reeves, and I'll be chairing our session today. So welcome, everyone. We are delighted to have so many of you join us this morning. Now, for those of you who don't know Creston Reeves, we're really here to help our clients with so much more than just accounting, business, and wealth advice. We support you in achieving your ambitions so that you can reach your brighter future, which is also why we host these webinars to help with any questions you may have and share our insights. So I'll just start with a little bit of housekeeping for today. This webinar is being recorded and a recording will be sent to you all later in the day. IT permitting, we'll be asking for a little bit of interaction by taking some polls throughout the presentations so that we can share those results with you and generate some further discussion. And there will be a pop-up survey at the end of our session today, and we'd be really grateful if you could spare just a couple of minutes to provide us with some feedback. Now, we've already had some questions sent in from participants before today, but please do continue to submit your questions throughout this webinar using the question functionality shown on screen so that we can answer those for you. Now, I'll leave that there just for a moment whilst you familiarise yourself with the function, and we'll come to your questions at the end after our panel have presented. So we hold these finance focus events every year to help keep our business clients and contacts updated and informed and to answer the questions you have. And we're going to be spending the next hour or so updating you on recent or upcoming important changes to keep your technical knowledge of the ever-changing regulatory landscape up to date. That's going to be followed by our Q&A session where you're going to have the opportunity to have your questions answered by our presenters. So before I introduce our speakers, we'd like to hear your headline sentiment on the possible outcomes of the upcoming election. So the general election poll tracker as of yesterday showed Labour at 41%, the Conservatives at 20%, Reform at 17%, the Lib Dems at 11%, and other parties collectively at 10%. Now, with both the main parties committing to not raising the main tax revenue earners of income tax, national insurance, VAT and corporation tax, the devil is really in the detail as to whether their proposals deliver enough in the right areas for business. But what is clear is that with a commitment to reduce debt alongside these tax commitments, economic growth is going to be an essential component to deliver on their promises. So let's move into our first poll. Let's get your perspective. It's just going to come up on screen. Do you believe that a change of government would be good for business? Is that a yes from you? A no? Are you undecided? Or you might just prefer not to say? So I'll leave that there for a moment while you fill that in. And I think we'll be able to show those results on screen. So a change of government, 37% yes, 24% no. So there's definitely a margin ahead, but quite a lot undecided. So perhaps that devil in the detail still needs to be drawn out for people to be convinced whether a change is good or not. And obviously we know that business loves stability and change might not provide that. Great, thank you very much for those answers, everyone. So I'll just share with you now the areas we're going to be covering for you today. So we're going to start by considering the wider economic factors at play. Then we're going to move into an update on financial reporting and the future of audit. We'll share with you a corporate tax update and changes on the horizon and provide you with some reminders on research and development share schemes and the use of the scheme. Before we move on to questions, we'll be sharing insights into how valuations are used within the financial statements. So to introduce our speakers today, I'll just invite them to come back on screen. We have Phil Eckersley, former agent of the Bank of England. We have Peter Manser, one of our audit partners. We have Mohammed Mujaba, a corporate tax senior manager. Sam Jones, one of our corporate tax partners, and Tom Wacher, our valuation and forensic accounting partner. So we're going to see all our panelists later on as they go through their presentations and when we have the Q&A. But I'll say goodbye to everyone except Phil for now. Now, in previous years, it's turned to me at this stage to give you an economic update, but we're delighted to enhance our session this year with an economic update and forecast from someone who spent much of their career gathering insights into all sectors of the economy, former agent of the Bank of England, Phil Eckersley. Phil, welcome. It's great to have you join us, and I'm going to pass over to you now for the economic update.
Great. Well, thank you very much, Jenny, and I hope I can add some value as you promise. I'll try and over deliver. So, good morning, ladies and gentlemen. My presentation this morning is going to draw quite heavily on the recently published Monetary Policy Review by the Bank of England. In turn, this, of course, is based on assumptions on government fiscal policy, and they won't change specifically if we get a change of government. The new government tends to inherit the Blue Book detail. So I've been allocated 10 minutes to cover a very broad landscape. So without further ado, I'll go into the first slide looking at the policy rate. This first slide shows the evolution of monetary policy in the UK, the US, and the Euro area from the onset of the pandemic right through and then morphs into what we call market policy rate expectations. These expectations are important because in recent years, the forecasts that the bank produce and that we will look at later are conditioned on an expectation of these particular changes. Now, if we turn to these forecast areas, so these are the bits that start in 2024. And it's a combination of both the full colour and the dotted lines, but maybe focus a bit on the UK, which is in sort of turquoise colours. You can see that in recent years, central banks and the Euro area have increased respective policy rates in response to that significant inflationary pressure that emerged in the post-COVID global economic recovery. And you can see in the chart also that the latest market implied paths moving out in 24, 25 and 26 suggests that those policy rates are likely to be reduced in coming quarters, with some changes to the expectations of the timings. Stronger economic data, in particular some inflation releases in the UK, the US, have meant that central bank communications have pushed out the timing of the future reductions in the policy rates. And you can see that by just comparing the solid line, turquoise line for the UK with the dotted line. So the more recent solid line shows that market expectations for UK policy rates have risen by about 70 basis points over the next 3 years on average. So in other words, monetary policy is not going to be as loose as expected back in February. And this does have implications for growth and inflation. So let's have a quick look at the next slide on growth, which shows the UK GDP and highlights in particular the rollercoaster nature of the impact of COVID that's taken the extreme readings in 19, 20 and 21 off the scale. So this chart follows the outturns in the solid orange line and then moves into forecast periods, as you can see, in 2024, and is surrounded by a swathe, given that there are changes to these numbers, even changes to some of the historic numbers where data get revised. But the swathe widens as you go through the forecast period, and in particular reflecting the greater uncertainty as you work through this particular fan chart. So after this massive roller coaster of a ride, you can see that through 22, 23 and data releases for 2024 show that the economy is pretty much flatlining. I mean, it's probably about as dull as a 1-1 draw with Denmark if we were drawing analogies with football at the moment. According to the latest releases, UK GDP rose by 0.6% in the first quarter, which was relatively strong, but it's expected to weaken to 0.2% in this forecast in the second quarter. So this follows growth that was weaker than expected in the second half of last year when the UK entered a technical recession, which I've just highlighted here in the red circle. In particular, late last year, household consumption was weak, squeezed by higher interest rates, fiscal drag, and faster higher energy costs. Nonetheless, growth is expected to pick up in 24, supported by some recovery in real incomes as nominal pay rises faster than inflation. And in part, that reflects the continued unwinding of the shocks to energy and other imported goods prices, which we've experienced in recent years. And also, of course, the effect of lower national insurance contributions. So that real post-tax labour income probably grow at about 3% for 2024 as a whole. The arrows highlight the consensus forecast for a range of external forecasters and predicated on assumptions that interest rates will fall through the forecast period, as we saw in the previous chart. You can see from this their assumptions are slightly more optimistic than the Bank of England's based on the interpretation of broadly the same set of data. But given the uncertainties in trying to forecast economic behaviour, I wouldn't regard them as significantly stronger. Turning to the international outlook, there remain some notable differences in the patterns of international economic activity. Recent growth outturns tended to be stronger in the US and somewhat weaker in the euro area. However, activity in the euro area is projected to pick up in the near term, accounted for by the fading impact of tightened policy and by some growth in real incomes. US GDP growth, in contrast, is expected to slow somewhat over the forecast period as the boost from the consumer dissaving fades and the uncertainties over the election dampen confidence. I mean, the US received a significant boost, a sort of sugar rush, from all the fiscal loosening of policy that happened there through the COVID period, and savings were built up significantly. At home, however, UK fourth-quarter GDP growth is projected to pick up through the forecast period to just over 1.5%. That reflects the fading negative impact on growth from past increases in bank rate. Turning now to the labour market. So this chart shows unemployment rate projection based on the market interest rate expectations that we saw earlier. You can see the unemployment rate in the solid purple line, and then from the forecast period, the swathe opens out in terms of the fan chart as the uncertainties increase. There's always difficulty in trying to determine statistics derived from labour market surveys. So it makes it very difficult to gauge the true evolution of the labour market. However, the latest LFS data, the labour force survey data, appear to suggest that unemployment rate has increased over the past year, currently sitting at around 4.5%. This has occurred at the same time as an historic rise in the inactivity rate. Underlying employment growth has also slowed. So we've got some interesting counter factors here. We've got employment growing, but also unemployment growing, and also at the same time inactivity growing. But this is a reflection of population growth and some demographic factors. If we try and put all these indicators together, I think it suggests the labour market continues to loosen, albeit modestly. The good news is this has a typically dampening effect on wage demands. Looking ahead through the forecast period, demand growth is expected to remain weaker than potential supply growth throughout most of this time, such that the margin of economic slack will emerge, probably during late 24 and early 25. And of course, that in part reflects the continued restrictive stance of monetary policy. As we tighten, we continually have an effect on demand. Thus, the unemployment rate is projected to rise somewhat over the first half of the forecast period, rising above 4.5%, which is often assumed to be the equilibrium rate of unemployment, through the middle of next year. Some of the slack in the labour market that is expected to emerge over the forecast period also reflects this weakness in participation rate, and that should further ease wage growth expectations. Of course, there are risks in both directions around the future path and the future path of the unemployment rate. Vacancy rates remain high, but off their recent peak, and business surveys continue to highlight labour market shortages across a range of skills. Let's turn now to CPI. Inflation is running close to the 2% target and will do through the second quarter of this year, as shown by the diamonds on this chart, which show the latest reads in CPI. CPI then increases slightly in the third and fourth quarter to around 2.5%. The profile of CPI inflation over the second half of the year is more than accounted for by developments in the direct energy price contribution to 12-month inflation. So it's just technical effects of year-on-year changes. CPI inflation excluding energy is projected to be around 3% during the second half of the year, owing to the persistent domestic inflationary pressures. As part of the MPC's role, it will continue to monitor very closely these indications of persistent inflationary pressures, and really the amount of slack and resilience in the UK economy as a whole, looking across a range of measures of the underlying tightness of labour market conditions, wage growth, and services price inflation. And in particular, services CPI remains persistently high, but is expected to ease gradually over the course of this year as wage growth and indirect effects of energy and other goods prices weaken further. Annual private sector regular wage growth has also declined in recent months, broadly in line with alternative indicators. Recent outturns in wage growth have continued to be stronger than expected, nevertheless. So this persistence in inflation that keeps the MPC awake at night, I think is still affecting market interest rate expectations. So if you think back to that early chart and how the future path of monetary policy is expected to be a little less shallow than it was before, so with the gradient being somewhat tighter and rates staying higher for longer, then all this I think is partly reflective of persistency of inflation. So throughout the forecast period, CPI is judged to ease further as capacity opens up. And you can see the central darkest area on that line continues to ease back in 2026 and early 2027. There continue to be some upside risks, of course, to the modal CPI inflation projection. That's the darkest orange swathe, from particularly geographical factors and geopolitical factors. So concerns about the supply of goods through the Gulf, continual wars across the globe. And that will affect the potential for inflation during the first half of this forecast period. Set against that, recent weakness in Chinese export prices could pose a modest downside risk to UK inflation if they were to intensify, for example, alongside softer Chinese activity. So if we were trying to summarize these risks around inflation and looking at the sort of size of the swathes above and below the modal projection, the risks, as judged by the policy committee, are evenly balanced, following an extended period in 2023 when they were particularly skewed on the upside. So you may ask yourself, well, how good has the Bank of England been in forecasting these things? And I suppose hand on heart, inflation's been one of those areas where it's been very difficult to gauge the actual outturn numbers, not alone 2 or 3 years in advance, but just in the next 12 months. But on growth, when we looked at the previous chart, growth expectations have generally, COVID notwithstanding, hit between the fan chart projections, as we've seen. So in 10 minutes, I've tried to cover the 3 or 4 main features, but if there's bits I've missed out, then please feel free to lodge a question, and I will try my best to address it. Thank you.
Thanks so much, Phil. That was really interesting and insightful, and I'm sure there probably will be some questions that we'll come back to later on that. Interesting to hear you say that growth in the US has maybe had some impact from the election going on there. So I wonder if we could see something similar here, but maybe that'll pop up in our questions later. So thanks very much, Phil. That's great. We're going to move on to our next presentation now. I'm going to invite Peter to join us on screen. Peter's going to be talking you through financial reporting and the future of audit. Over to you.
Thank you very much. So let's consider the topics we'll be looking at this morning together. We'll consider some changes to audit exemption that have been announced. some Companies House changes that have already been implemented, so catching up on those. Again, some accounting changes driven by the changes to the accounting standard. We'll look at particularly 2 issues that emerged from that. And then briefly touching on Financial Reporting Council, what they see as the current hot topics in accounting, and ESG reporting as well. So let's consider that first topic then of audit exemption. We've had audit exemption for some years, and just as a reminder, it's small companies that qualify to be exempt from the requirement for an audit. And to be a small company, the size criteria has to be met. And if you recall, there are 3 measures of this: turnover, total assets, and the number of employees. So currently, the requirements are that turnover has to be less than £10.2 million. And we see here how the new limits have increased quite significantly. They've increased by 50%. Now, the last time these changed was back in 2016. So it's been some years since these numbers have changed. And obviously, over that period of time, we've seen the impact of inflation, but also perhaps the current government's desire to reduce red tape. So the new limits that have been introduced is turnover of less than 15 million and total assets of less than 7.5 million. The number of employees remains static at 50. So it's the financial limits that have changed, not the number of employees. So what's the impact of this then? Well, we can see, can't we, that quite a sizable company with turnover of less than 15 million could be now audit exempt going forward. So a company of that size can be quite significant in its local area or in a particular specialized sector that it may operate. So you may see competitors or suppliers or customers taking advantage of this. When? Well, it applies for accounting periods beginning 1st of October 2024. So quite a change coming up in a relatively short period of time, but we'll see these accounts obviously being filed sometime later after that period commencement. So an interesting development on audit exemption. This was announced back in March, so fairly recently, by the current government. We would not expect that to be changed by any change in government, but you never know with these things. That's the stated intention at the moment, but it hasn't been implemented yet and will require parliamentary time. So we might see a delay to the implementation. So that's audit exemption. Moving on to our next topic then. Let's look at some Companies House changes. Now, these are driven by a law that was enacted in October of last year. So a number of changes will come from this new act, the Economic Crime and Corporate Transparency Act. Now, this was brought in with cross-party agreement, essentially, to try to combat crime, money laundering, corporate crime by using sham companies. So what has already been implemented from this new law, and there's a whole raft of other changes yet to come, but there are 3 significant things that have been implemented in March of this year. Rules regarding registered offices, addresses, we'll have a look at that in some detail. A new requirement that every company on Companies House Registrar has to have a registered email address with the Registrar of Companies. Now, interestingly, that email address is not to be published, but every company will have to have one, and they'll be used by Companies House for communications with the company. Now, interestingly, that won't be published at all. That will be just private communications from Companies House to companies. And also, one email address can be used for multiple companies as well. Another requirement is that when we set up a new company, there's going to be a specific statement of lawful purpose. So clearly setting out a legal requirement. The company's purpose is one that complies with all laws and statutes. For existing companies, that statement will be picked up on the annual compliance statement that we have to file at Companies House. So a couple of changes there. Let's look at the Companies House registered office address changes in a little bit more detail. What is required is that each company now has to have an appropriate address, not a sham address that some company can hide behind. What do we mean by appropriate address? Well, this is defined as where documents can be recorded as being delivered. So it has to be a physical address where physical documents can be delivered to that address. It also has to be a place where a physical person can accept those documents, and that person will be acting on behalf of the company. So in reality, this means that there are no more PO boxes that can be used for companies' registered office addresses. And the penalty for not compliance with this is ultimately the company being struck off the register. So some important changes just to be aware of in terms of company house rules. Let's move on to the next topic then. And we come into the meat of our presentation here, and changes in accounting financial reporting. And these are driven by changes to Financial Reporting Standard 102. Now, this is the principal accounting standard that we use in the UK for those companies that are not applying the international financial reporting standards. This accounting standard 102 is maintained by the Financial Reporting Council. So why are these changes coming about? It's because the FRC, Financial Reporting Council, have committed to a periodic review of the accounting standard. Why do they do that? Well, they want to improve on accounting corporate reporting, but also they want to look at any changes to the international standards and, where applicable, adopt those as well. And we'll see this is the reason for changes in this particular edition of FRS 102. So what is changing? A number of changes. The two principal changes we want you to be aware of is relating to leases and to revenue recognition. When does this apply? Well, it's sometime off in the future for accounting periods beginning in 2026, but that doesn't mean to say that we can rest on our laurels, because this really is a time that we can prepare for these changes. As we go through these two principal changes, you'll see that there's some information that we need to gather and some consideration of the implications of the changes that are coming into effect. So let's look at the first topic then, leases, in some detail then. Accounting for leases. Now, this is a topic that we have covered in previous finance focuses with you. And we've highlighted the direction of travel, and now it's actually arrived the accounting changes. So the new accounting standard will require that all companies place all their leases on the balance sheet. So no more off-balance sheet finance through leases. What does this mean? Well, on the one hand, we'll have an asset, and on the other hand, we'll have a corresponding liability, so the balance sheet continues to balance. Now, the impact on the profit and loss account, this is interesting as well. So the moment where we account for an off-balance sheet lease, then the lease payments are charged against the profit and loss account as an expense. Now, that will be replaced with the depreciation of the asset on the balance sheet. That's described as a right of use asset, so that appears on the balance sheet, and therefore will be written off over a period of time through depreciation through the profit and loss account. And then the interest element of the lease payment will be recorded as an expense in the profit and loss account. So a big change potentially to the look of the balance sheet in terms of assets and liabilities, and quite a big impact on the profit and loss account where you have a number of leases. So let's consider that in a little bit more detail. So if we're putting on the balance sheet the assets and the liabilities, so some key measures will change here. Obviously, people look at the net debt in a company to see what the exposure is there. That's going to increase quite significantly if we have a number of leases that we're now recognizing the liability, and also the impact on certain profit measures such as EBITDA. So that's often used, these measures are often used in terms of bank covenants. So borrowings with the bank, will they be affected by this purely accounting changing? Pension fund covenants, again, we need to look at those where applicable. We've just spoken about audit exemption, but if we're putting loads of assets and liabilities on the balance sheet, suddenly the balance sheet could look quite different. So again, that could be a factor that we need to look at. Do we still qualify for audit exemption if we've increased significantly the value of the gross assets being recorded on the balance sheet? And then what about remuneration, profit sharing bonuses and things like that, and dividends? Again, if we're affecting the profit and loss account, then these measures could be impacted as well. So that's the first important change we need to be aware of, leases then. Moving on then, what do we see next? Well, what is the transition then as we move from the old off-balance sheet to the on-balance sheet accounting for leases? Well, this is going to be quite a simple approach. There's going to be no restatement of comparatives, so not treating it as a full prior year adjustment. but rather we'll have to measure the cumulative effect on the opening reserves, and the opening retained profit will be adjusted for the impact of this accounting change. So effectively what this will mean, we'll have a line showing retained profit previously reported, changes to the FRS 102 as a result of identifying all the leases, and then we'll show the effect of the restated balance, which will be the balancing figure going forward. So in terms of transition then, there's quite a lot of work in identifying what leases we have in the business, and do we now have to move them on balance sheet? What is the cost that we would recognise? How far are we in their useful life? What accumulated depreciation do we recognise as well? So quite a lot of fact gathering to identify the leases involved and how we're going to account for that. Now there are some exemptions for this in terms of low value leases and also short-term leases as well. These exemptions are quite limited, so effectively most leases will be accounted for on balance sheet going forward. So that's the first big change that we need to be aware of. What's the second one that we want to consider? Well, that's revenue recognition. And when you look at the detail of leases, there is certainly room for complication. And this is certainly the case with revenue recognition. What we're doing is adopting a 5-step revenue recognition model, taken effectively straight from the international accounting standards. So here in the UK, we're aligning ourselves with international standards where listed companies and large companies have already adopted this 5-step revenue recognition model. Again, its impact clearly on revenue recognition is going to be on turnover and therefore potentially profit measures such as EBITDA, as we saw with leases. So we're looking particularly at the timing of when we recognise revenue. So this will unwind over a period of time, but as we report in accounting periods, the amount of revenue we now recognise in an accounting period could in some circumstances be quite different and therefore could have quite a large profit impact. Let's explore this in a little bit more detail as to what we mean then. So what are the impacts? Again, if we're changing turnover profit, we need to consider bank covenants, pension covenants, again, the audit exemption if we're changing turnover limits, and again, the impact upon profit sharing schemes such as bonus schemes or share option schemes. And what about dividends as well? Again, if we're impacting revenue recognition, therefore profit, we have to look at the impact if we're in the habit of paying out dividends. So let's look at the 5 steps then. What do we mean by the 5 steps and what is the transition? Well, here it's a little bit more complicated than the leasing transition. We have the option of restating comparatives, or as we saw with leases, looking at the cumulative profit effect and changing the retained opening profit in the accounting periods. So we can account for it as a full prior year adjustment, as we're familiar with, or merely align the account showing the impact on the opening retained profits. So now it's time to look at some more detail then as to what we mean. The 5 steps. Here we have it on the screen, the 5 steps, identifying the contract, looking at the promises within the contract, determining the transaction price, and then allocating that price to the various promises in the contract, and then recognizing the revenue when that promise is satisfied. Now, that seems at first read quite an easy exercise, but there are these 5 steps we need to go through, and that's on every particular revenue stream. So in a simple company where we've got one source of sales, that may be quite an easy exercise that we need to go through. We still need to go through it in preparation for this change. But in a company where there's multiple revenue streams, suddenly this can become quite a complicated exercise in just preparing for the change. Let's see if we can illustrate some of these points then. So let's take an example then, and we'll look at just the first step. So just the first of the 5 steps. You may recall that was identifying the contract and whether a contract exists to recognise revenue. So let's take the example of a builder of new homes. He has a written agreement to sell one of his houses on his new estate. He's actually holding a deposit from the customer. Do we recognise the revenue? Well, at the year end, we've got some more details. So the builder A ascertains that his buyer hasn't been able to progress his mortgage application. The solicitor is no longer answering emails or telephone calls. Well, no change there, you might think, but maybe it indicates some problem with the progress of the contract. And when the builder looks at his buyer, he finds that the buyer's house is still on the market for sale. He hasn't even been able to sell his own house first. So at this point, under this new regime, we would conclude that a sale is not likely under those circumstances. So at the year end, even though we're holding a deposit and we have a written agreement, we would not recognise the revenue in terms of that potential sale. So let's look at the next slide then for some more implications of this. So a contract does not exist. Under that first step, we don't recognise the revenue, and the cash that we have received, we hold on our balance sheet as a deposit and do not release it to revenue. So that's one example of the complications that can arise. Let's look at another example now. And again, we'll look at just the first step about whether a contract exists on which we can recognise revenue. Here we've got manufacturer B. So he has a customer that is a regular customer. The customer places an order before the year end, and B delivers those goods before the year end. Now, normally the paperwork that accompanies the sale includes a signed order from the customer. At the year end, we don't have this in place because of some IT issues at the customer. But when we discuss the matter at the year end, the customer is expected to meet the obligation to buy those goods from the previous history. B expects the sales order will be signed, the paperwork will come through in time. And on that basis, in these circumstances, even though we haven't got a signed contract in place and the normal paperwork, we conclude that a sale should be recognised. So different circumstances and a different conclusion. Moving on then. Let's look at step 2. We looked at just a couple of examples on step 1. Step 2 was identifying the promises in the contract. Now, in a very simple contract, we might just have one promise, and that's easy. We can move then on to steps 3, 4, and 5. But let's illustrate some of the complexities that can arise. Here we've got a car dealer, C. Now, a part of the deal to attract customers, he provides a service free to his customers when they buy a new car. The service is provided 6 months after the sale. Now, here in this contract, in these circumstances, we can see effectively there are 2 promises. One is the sale of the car, and the second one is the provision of the service. So because we have 2 promises in the one contract, we have to split the revenue. The revenue for the sale of the car is recognised when the customer takes control of the asset, when the sale is made, and the revenue that we would allocate to the value of the service is when the service obligation is fulfilled 6 months later. So you can easily see a scenario, can't you, where the year end falls between after the sale of the car, but before the service is provided. In which case we have to split the revenue and recognise it in different accounting periods as we identify that there are 2 promises in this contract. Now let's fine tune this example a little bit in the next example that we've got here. Here we've got car dealer D. Now he's going through his sales, monitoring the sales in August, his busiest month. Halfway through, he recognises that sales are not meeting budget, so he has a sales incentive campaign. He will introduce a new incentive of providing first service for free in each car that is sold in August. Now, customer E has already bought a car before this promise is made on the 1st of August, but D has said he will honour his servicing obligation to all existing customers. Now, in this case, with customer E, there is just one promise in the contract, and that is the sale of the car. So we recognise the entire revenue on the sale of the car that happened on the 1st of August. Now, the revenue relating to the service obligation, no, there's no promise, so we don't recognise that. But what we do have to recognise is the cost of the obligation that's been given in that promise that's been made. So whilst we recognise the complete revenue, we also have to recognise that provision for future costs for when the car is actually serviced 6 months later. So in one example, where there's two promises, we have to split the revenue. In this case, we recognise 100% of the revenue relating to the one promise in the contract. So we begin to get a flavour of the complications that arise when we look at the 5 steps. And we've looked at just 2 of those 5 steps to see the complications that can arise. So when can complications arise? Well, when the expected performance of the contract does not meet the actual stated contractual terms. That can be perhaps through constructive obligations, past performance, where there are multiple promises, particularly where services are bundled in one contract. Then we need to split out all those promises and allocate revenue to each one. And when contracts are modified, perhaps after they've been entered, again, that's an area of complication. So really, with these changes, particularly with revenue, for example, you need to be speaking to your regular Creston Reeves contact to explore what these mean for you and your business. Let's look at the next slide then to see where this leads us then. Well, what is the action required? We need to look at all our revenue streams in preparation for the implementation of this new change according to the 5-step model. And remember, this is for accounting periods beginning 1st of January 2026. So we have some valuable time to prepare for these changes. Moving on then, what do we see? We see that there are 2 big changes from this accounting standard, one on leases and one on revenue recognition. And they will affect how your balance sheet and how your profit and loss account look in the future. And they're effective for accounting periods beginning 1st of January 2026. So now is the time to prepare. So do reach out to your Creston Reeves contact and explore what these changes will mean, what information you need to gather in good time so that we're all in a good place for these accounting changes and we understand the implications of them. So that's the topics we wanted to cover there. Let's move on now in our presentation to consider the FRC, so the Financial Reporting Council. Now, their stated purpose is for the public interest in setting high standards of corporate reporting and holding to account those responsible for delivering them as well. So the Financial Reporting Council are the regulator that operates at the top here in the UK in terms of corporate reporting. So what do they see as the main issues in corporate reporting? Well, they've recently published their top 10 issues. So please cast your eye down this list of 10 topics that are concerning the FRC. Now, if your accounts, your financial statements incorporate any of these factors, again, it's something to reach out to your Creston Reeves contact to make sure that you are up to date with what the FRC's rulings are on these matters. Now, as you would probably expect, the FRC are particularly concerned on areas where there's judgment and choice. Now, there are disclosures regarding those in the financial statements. So impairment judgments are the top 2 that the FRC are concerned about. Perhaps surprisingly, for larger companies that have to report on their cash flow statement, they often find errors in the cash flow statement. So that's in at number 3. Number 4 is something that auditors in particular need to be concerned about, and that is on narrative reporting. And what the FRC are concerned about is in the director's report, the strategic report, often the very glowing report from directors don't really chime with the actual numbers that follow later in the financial statements. So it's that disconnect between the narrative reporting and the hard numbers that the FRC are concerned about. So have a look at that top 10, think about your accounts and consider whether any of those top 10 issues relate to you. Now, the FRC have issued thematic reviews on most of these areas, so there is some guidance on the FRC's thinking on these matters. Moving on then to our next slide. Let's just conclude with a brief thought about ESG reporting. So environmental, social and corporate governance reporting. These are issues which are getting a lot more attention, both in the general press and obviously in the financial press as well. So what's happening in the regulatory landscape? So here we're talking about sort of non-financial reporting. Here in the UK, listed companies already have to report on certain ESG matters. Large companies have to report on their carbon reporting. So this is already coming into place. This is increasingly important to customers of certain companies, and interestingly as well to employees. Often employees embarking on a career will consider the ESG impact of their chosen career and look at the accounting of the potential employer and consider whether that's a business they want to be aligned with. So it's something we need to be aware of, and its rising importance. Now, in terms of what's the regulation around this, obviously it's a new area of reporting. It's not on hard numbers as such, so it's quite a judgmental area. So as mentioned, here in the UK, listed companies, large companies always have to report on this already to a limited degree. In the European Union, there's a new standard that the EU will be applying to corporate reporting, and that's probably going to influence us going forward. The international standard body that's responsible for this has released 2 new standards on reporting, and the UK government has indicated that it expects to adopt these in 2025. So reporting on ESG matters is going to increase in the future. It's something we need to look out for, to be aware of. It will affect listed companies and large companies first of all, but inevitably we can expect it to drip down to smaller companies as well. So that's something for the future we need to keep an eye on. So back to Jen. Let's see what we will be concluding next. So we've covered audit exemption, company's house changes, accounting
Great, thanks very much.
102, and what the FRC are looking at as hot topics. Jen.
Thanks very much, Pete. Sorry to interrupt you just there. That's really interesting to hear. I mean, that's quite an extensive list from the FRC, isn't it? I imagine most of our clients will look at that list and feel there's at least one area that they'd like to understand a bit more about. And it's great to hear your update on ESG and sustainability. I think we're seeing the increasing importance of that in terms of both our clients and the people that work with us and our communities. And inevitably, I guess, alongside the reporting requirements that are coming in, clients might see it coming through in terms of their delivery of services to other businesses as well, people asking about what their climate commitments are.
Yeah, it's
thanks very much.
Isn't it? And it's something that we're very much closely monitoring the developments in terms of reporting as well to help our clients.
Thank you very much, Pete. I'm sure there'll be some more questions on that later. So next we're going to be passing over to Mohammed, who will be discussing the corporate tax updates and upcoming changes on the horizon. So I'll pass over to you.
Thanks, Jen, and good morning, everyone. So this morning we'll start by revisiting some of the changes to corporation tax and how they could impact your business. Next, we'll look at the interaction of the recent interest rate rises with tax. And finally, we'll touch on some developments in the international space. So on to the first part, corporation tax changes. So most people will be aware that the rate of corporation tax is now 25% for most companies, i.e. those with taxable profits in excess of 250K. And those with taxable profits of 50,000 still remain taxed at the older rate of 19%, with an effective tax rate of 26.5% for companies that have taxable profits between 50,000 and 250,000. There is a reintroduction of the associated company rules, which we had previously in 2015, which is the last time we had a non-unitary rate of corporation tax. And broadly, associated company rules are where one has control of the other, so one company has control of the other company, or both are under the control of the same person or persons, and they include worldwide companies. Now, the reason that the associated company rules are important, as it says there, is they are used to reduce the thresholds for quarterly payments, which is 1.5 million and 20 million for QIPs and super QIPs respectively. So quarterly installment payments and super quarterly installment payments, where payments are accelerated by 4 months. In addition to the corporation tax rate change, Full expensing, which allows up to 100% tax relief on CapEx, was made previously. It previously had a sunset date of March 2026. And this is unlimited and applies to brand new plant and machinery used in a trade, giving relief of 25p for every pound spent. So how do these changes impact your business, and what are some planning points to think of? So the introduction of the associated company rules, as I previously mentioned, means in some cases the normal thresholds are reduced considerably, accelerating tax payments to HMRC and therefore the cash flow burden to businesses. An extreme example is recently where we had we were acting for a 3 UK company group owned by a non-resident, non-dom individual. The companies made modest profits, so paid some tax in the UK, but after the normal sort of 9 months after the year-end time period for payment. It transpired upon further investigation that the same individual also owned another 35 companies overseas and worldwide. So the UK company group was immediately into superquips, so that all tax liabilities were to be settled before the year end to which the liability relates. So this means it's worth revisiting how your business affairs are structured, and it could be to minimize the number of active companies held by the same person or persons or corporate group, to reduce the number of associated companies and therefore stop falling into quips or super quips due to thresholds being breached. Alternatively, it might be to bring a loss-making company or group of companies into a profit-making group to access losses and reduce overall liabilities. In terms of full expensing, that can be useful for businesses which are capital intensive, but in most cases, it's a much more significant consideration will be the impact of inflation and higher costs of financing, eroding a lot of the tax benefit and incentive. Furthermore, as the full expensing operates alongside the annual investment allowance, or AIA, with its £1 million limit, full expensing is likely to be far less useful for most businesses that never hit that level of spending, especially as AIA is usually far less restrictive and provides more relief generally. So moving on to the impact of interest rates in the tax landscape. So as you know, interest rates have been rising, although stabilized more recently, and within HMRC interest rates directly linked to the Bank of England base rate, potential late payments of tax now attract a significant penalty in real cash terms. Alongside the increase in the corporation tax rate and the associated company rules I mentioned just now, this results in paying more tax earlier with a potentially higher penalty for non-payment. One interesting aspect of this is that credit interest rates, so where companies or businesses have made overpayments of tax, the repayment or the supplementary interest on that is now increased. It's currently at around 3.5% or so, but that's still significantly below the penalty rate for late payment of interest. Another consideration is the UK's corporate interest restriction regime, or CIR. This broadly limits the amount of tax relief you can get for deducting interest and other financing costs in the UK, either in individual companies or groups of companies. Although a very complex set of calculations and workings are used to determine the actual restriction, there is broadly a de minimis amount, which is 12 million for a 12-month period and one group of companies. But with the increase in the interest rates, this limit could potentially be breached quicker, and therefore additional work would need to be done to check if the restriction applies and to what extent. This not only results in additional administrative costs in terms of doing the calculation and making sure any restrictions are not breached, but also if the interest deduction is restricted, then it will accelerate tax payments where the interest deduction is not allowed or it's deferred to a later period. So moving on to the international aspects. Recently there was the base erosion profit shifting pillar 2, so BEPS pillar 2, which introduces a minimum 15% rate of tax for international groups. Now, international groups as defined are those with annual global revenue greater than 750 million euros. And the minimum tax rate is effectively to be policed by way of 2 pieces of domestic legislation in the UK, working in tandem but with different targets. So multinational top-up tax will impose an additional top-up tax on UK parents who have interests in entities in territories with effective tax rates lower than 15%. And this will bring the overall effective tax rate of the group to the target 15%. Conversely, domestic top-up tax will impose an additional top-up tax on UK companies to ensure that the effective tax rate in the UK is 15%. So the two effectively work in tandem, albeit at the opposite ends of the spectrum, to ensure that the UK doesn't, there is no tax leakage from the UK, where the effective tax rate is 15%, so that other territories where the rules are in place do not obtain what will be seen as the tax benefit of these rules. The rules are in effect for accounting periods after the 31st of December 23. So those with operations in multiple jurisdictions, and particularly those where the local tax rates can be lower than the effective 15%, should just be cautious. So to summarize, we've effectively got the triple whammy of a higher corporation tax rate, effectively up to 26.5%, albeit it's usually 25% for most companies, payments being due earlier under the associated company rules, and late payments incurring higher rates of interest. This has a knock-on effect for businesses, putting significant pressure, not just from a cash flow perspective, but also administratively. And finally, those businesses with international operations should also be mindful of the effects of the top-up tax legislation, not just for the UK, but also worldwide, as these rules will be replicated in a number of countries. And with that, I'll hand back over to Jen.
Great, thanks, Mohammed. I think that's some really interesting things for people to be mindful of, isn't it? And I guess highlights the importance of really keeping a regular check on your sort of management information throughout the year, to be cognizant of things, particularly like quips and super quips and falling in it with the group company rules. That's great. Thank you so much. So we'll say goodbye to Mohammed for now until we reach the Q&A session. But next, talking to us about research and development and share schemes, that's going to be explored by my colleague Sam Jones. So I'll pass over to you, Sam.
Thank you, Jen. Yeah, so as Jen mentioned, I'm going to be covering 2 key topics today. The first one is R&D tax credits. The R&D landscape has changed a lot. So there's changes that are already impacting claims now. There's also announcements that will impact future claims, and the merge scheme has also been announced by HMRC. The second topic I'm going to touch on is how can you retain and incentivize your key employees? I think that's one of the key challenges businesses are facing, just making sure they can retain their key talent. Okay, so let's start looking at where we are with R&D tax credits. So things that have already changed and are impacting current claims for R&D tax credits is the rate of relief. So SMEs have seen a reduction in the enhanced deduction available to them, whereas those large companies that fall within the RDET scheme have actually seen an increase in the credit available. HMRC are focusing what can be claimed for R&D tax credits and are focusing that on UK-centric spend. So we'll have a look at that a bit more later. The process has actually changed as to how you make an R&D tax credit claims. Any new entrants for R&D tax credits need to make an advance notification to HMRC, and they need to do that within 6 months of their year end. There's no requirement for those that have had a claim in the last 3 years. Also, any claim must be submitted with an additional information form. These requirements have been implemented to tackle abuse within the system and to increase the regulatory requirements there. To dovetail in with the tackle of abuse, we're seeing a higher risk of inquiry. So previously only 1% of claims were actually inquired into. That's now up to at least 20%. We're seeing that these inquiries are quite onerous and a lot of questions are being asked. So we're asking our clients that make claims to make sure that you spend more time up front to make sure that we're answering those standard questions that we're seeing. In the future, we've got changes that are coming, which is the merge scheme, which will be a single scheme for SMEs and large corporates. There will also be an R&D intensive scheme for those that are loss-making SMEs. And then I've had a quick look at the policies that are going to be coming in if there was a change in government. We can see that the Conservatives are going to continue to support R&D tax credits. The Labour campaign does mention innovation, doesn't specifically talk about tax credits, but does pledge to support innovation. So it'll be a watch this space there. So let's look at where we are with the R&D tax credit rates. So up to 31st of March, we were with SMEs, we had a 130% enhancement for R&D qualifying spend. And an SME is those that have up to 500 employees, less than €100 million turnover and less than 86 million gross assets. And if you were a loss-making company, you were able to surrender your R&D tax relief for an actual cash credit, which used to be up to 14.5%. And you can see there on the slide that if you're a profit company, that meant that you got a 24.7 effective tax saving. And if you're a loss-making company, that was up to 33 and a bit percent. You can see that there was a dramatic drop for expenditure incurred after 1st of April 2023, which meant that the R&D enhancement dropped to 86%. The R&D tax credit was reduced to just 10%. So that meant for a profitable company, the tax saving was 21.5% of your spend. That's also triggered by the fact that the tax rate is 25%. So actually that 86% is a bit more valuable than the 130% for profitable companies. But you can see that there was a disproportionate reduction in the saving for a loss-making company due to that reduction in the tax credit to just 18.6%. So after a bit of lobbying from the tax professionals and also R&D companies, HMRC have created a loss-making R&D intensive scheme, which means that if you qualify, then the R&D tax credit amount is back up to the 14.5%, which means you get an effective tax saving at 27%. That definition of loss-making R&D intensive is where your R&D expenditure is at least 40% of your total expenditure. The calculations are quite complex, but it should mean that those that are pure R&D companies are able to still make use of the scheme. The winners in the changes were actually those large companies that fall within the RDEC scheme or perhaps projects that are grant funded, where their RDEC rate was increased from 13% to 20%. The way that the RDEC works is that the R&D expenditure credit is actually taxed, so therefore the effective tax saving for a profitable company is 10.5% and is increased to 15% for a profitable company after April 2023. These rate changes are actually just based on when your spend was actually incurred, so you do need to split your spend pre and post that date. So what else has changed? Well, on the next slide, we'll be looking at the qualifying expenditure. So one of the sort of most important changes is actually HMRC are focusing their spend on UK-centric spend. So this will cover your UK, needs to be for UK subcontractors or UK externally provided workers. So those are those agents that might work for you. So the EPWs need to be subject to UK PAYE. This doesn't impact if you're using overseas employees. It's just for those sort of third parties that are included in your claim. There's very limited exceptions for any overseas spend. That might include something where it's wholly and unreasonably to undertake the R&D in the UK. So that might be due to geographical constraints or regulatory constraints, but it's a very small exception. These rules were originally due to come in for accounting periods beginning on or after 1st of April 2023, but they were pushed back a year to 1st of April 2024. So we haven't seen the full effect of these changes yet. The other thing that's changed is the advance notification. as I mentioned before, this is sort of to tackle abuse in the system. So if you are making your first claim for R&D tax credits, then you must notify HMRC within 6 months of the period end. Previously, you had a 2-year window to make a claim, which is your corporation tax amendment window. So that significantly reduced the opportunity for when you can make a claim. So if you've got a claim, make sure you're talking to your advisor early. There's no requirement to do the advance notification if you've made a claim in the last 3 years. The biggest sort of documentation change is actually the introduction of this additional information form, which must be submitted prior to the submission of your corporation tax return, and it's compulsory. So it prescribes what information you must include for each project. So a bit like your project descriptions, actually documenting how you're making an advance in science and technology. And it specifies how many projects you must include, and the spread must be broken down by project. We found that at KR, that our reports that we prepare for R&D tax credit claims covers most of these requirements, but one of the key changes is that you actually have to name a responsible officer and who your R&D agent is. So let's have a look at the merge scheme. So the merge scheme has been announced. It hasn't gone through Parliament yet, but it's going to be a single scheme for no matter what size you are, SME and RDEC. And it's going to be modelled on the existing RDEC scheme, which means you'll get a 20% expenditure credit and the effective tax saving will be 15%. There's going to be a new definition of subcontracting, which is a bit of a welcome definition there for us. So it means that the decision maker will be able to make a claim. Those of you who are already in the RDEC scheme, you might be able to now include some of your subcontractor costs within your R&D claim, which is great. The existing PAYE NI cap within the RDEC rules is quite restrictive. However, it's going to be now modelled on the more generous SME scheme, which means you should be able to get a higher credit back from HMRC. The good thing with the new model is that it actually aids the Pillar 2 considerations where Mohammed was talking about the minimum top-up tax, because we can see that sometimes the R&D SME scheme will reduce the effective tax rate in the UK to below 15%, whereas under this model, the credit actually reduces the tax payable that you need to pay to HMRC and not the tax that is due. So this single scheme, I don't necessarily see it as a simplification, because the merge scheme is disproportionate for those loss-making R&D companies. So there is a second scheme for loss-making R&D intensive companies, and that will continue to model on the SME scheme with that effective tax saving of 27%. That's most of the things that change on R&D. I just think it'd be good to contact us if you want to know how these changes are going to be impacting you, and we're happy to work with you to make sure you're meeting all of the new requirements. So just moving on to the second topic, is one of the key things businesses are saying is how do we retain and incentivize our key employees? The recruitment market is quite buoyant, and some of the bigger players in the market are able to pay some high ticket salaries to lure your talent away. So one thing that you could do is potentially reward via a cash bonus, but that's kind of rewarding past performance and doesn't necessarily retain them for the future. So what we tend to look at is share-based rewards that allows the employee to share in growth. It also allows them to feel like ownership in the business. There's several ways to do this. That might be just in actually an issue of shares to that employee, but that doesn't necessarily incentivize them to grow the business. So you could look at a share option scheme. One of the key ones that we see is the Enterprise Management Incentive Scheme, which is a HMRC tax approved scheme. It's extremely tax efficient and it's flexible as to how it's structured. So you could have performance targets, or if they remain in employment for 3 years, 5 years, then they're able to actually exercise that option and be issued shares. Or it could be just that, you know, if you're looking for an exit in the next few years, then you could have it as an exit only scheme. Not only is this tax efficient for the employee, it's actually quite tax efficient for the company, because these employees will hold an option. So that option isn't shares on day one, it's an option to acquire shares in the future. The option price is determined by today's market value, which would probably have quite a heavy minority discount, which means, you know, they are able to buy those shares in the future at today's price, in the future when the value of those shares is significantly higher. And not only that, the company is able to get a tax deduction for the value of those shares that employee was acquired. There are some caps within the enterprise management incentive schemes. The maximum options that can be awarded is up to £250,000. So, and actually the company needs to be a trading company predominantly. So you can't be if you're within an investment activity, and there are some excluded trades. There is another scheme which has less restriction, which is the company share option plan. However, it's not able to give quite the same level of incentive because there is actually a cap of £60,000 there, and is only really works where they're able to exercise their shares in more than 3 years. However, that is an option for some companies. Another option where those caps are restrictive for your business, depending on your size and what you're trying to achieve. Another thing we can look at is growth shares. So growth shares you're able to model them to protect the wealth that you've built up in the business today for those founders or those that have already been in the business for a significant amount of time, and actually allows your employees to share in the growth above a hurdle, which is set as part of a valuation process. So I think it's just good for businesses just to consider whether a share-based reward might be something that could allow them to incentivize their employees. That's everything from me. Thank you, Jen.
Great, thanks so much, Sam. So finally, I'm going to move on to Tom, who's going to be helping us to understand the various applications of valuations in business and some key areas to be aware of. Over to you, Tom.
Good morning, everyone, and thank you, Jen, for the introduction. As Jen says, today I'll be looking over the requirements for business valuations in financial statements. I'll be looking at 3 key areas: purchase price allocation reports, impairment reviews, and share-based payments. You'll have heard a couple of those areas already pop up in previous talks. So when relevant, these elements are key for finance directors to understand and manage so they can significantly impact a company's financial health and financial statements, and if not properly undertaken, can lead to issues with the audit or during any sale due diligence. However, first, with the election looming, I thought it'd be interesting to comment on the impact of a change of politics on valuation metrics. This is a bit tricky for privately owned companies, as deal data is commonly not available for up to 21 months after a deal is completed. However, the stock markets are live, and on the 21st of May, the UK election date was announced. The FTSE stood at 4584, and yesterday it was relatively unmoved at 4515. Whereas in France, on the 8th of June, the French CAC, on the date they announced their election, stood at 9622, but has fallen 5% to 9129, meaning London has taken back the position of the largest exchange in Europe. Now, what does that mean for small companies? Probably not a lot at this stage. We'll find out in due course. And perhaps the French fall is reflective more of the unexpected nature of their election and the possibly greater divide between the 2 political outcomes. But as a detail merchant, and I do have an affinity for detail, I will try and skip over some of the detail here. I've got less than 15 minutes now, so please do post anything in the Ask a Question facility if I skip over it and you're interested. Otherwise, please come back through your usual KR contact or through the post survey. The 3 areas I'm going to cover, for each of the 3 areas, I'm hoping to look at when you might need them, what each is, the importance of each, the overall approach to our valuation, though I think I'll skip some detail in there, and an outline of some of the challenges and opportunities arising. While many valuations are based on profit multiples, it was very interesting hearing what Phil said about inflation rates, as all 3 scenarios actually rely in part on the risk-free rate, which is closely linked to the rate of inflation. However, to some degree, expected changes are already reflected in risk-free data, so we didn't expect and we didn't see risk-free rates hit 10% when they peaked as they did in Phil's graph. It's the unexpected change that brings valuation differences. So let's move on to our first slide, really. We start with the purchase price allocation exercise. These are typically required on an acquisition of one business by another or during certain group restructurings, but they're not applicable to certain investment entities as defined by certain standards. I've put a definition on screen. There are numerous ones around, and I'll let you read through it. But maybe while this stays on, I'll just skip on to the next couple of points so you can read through. Why are they important? Well, firstly, they ensure that the financial statements reflect the true value of the acquired assets and liabilities on acquisition. They also assist with comparability between the financial statements. Secondly, sorry, Peter, they are necessary for the dreaded audit. And finally, in the event of an asset sale, they can benefit for tax purposes as the amortization of certain intangible assets can, in the right circumstance, qualify for tax relief. Let's move on to the next slide now then. But what are they? By way of a quick example, imagine a company acquires another with one real asset in it, a contract with its one customer. The acquisition price will inevitably be reflective of that contract value. The PPA exercise ascribes value to that contract by looking at its profitability, risk profile, and term. Now imagine a different business servicing thousands of small customers with no contracts. What brings those customers in? Is it their brand? Is it the technology being sold? And under the accounting standards, how do we value and recognize it? Well, IFRS 3 sets out the 4 steps. If we can move on to the next slide now, please. The first step is to identify the acquirer. This is usually a given. And then we identify the acquisition date. Also normally obvious, but not always the SPA date. The complicated bits come in the recognition and measurement of the identifiable assets acquired, the liabilities assumed, and any non-controlling interests in the target. We're often involved in relation to the instruction for the valuation of material intangible assets, such as brand, technology, or customer relationships. The final step is the difference between the identified assets, including intangible assets, and the purchase price, which generates the goodwill on an acquisition, or on a bargain purchase, the negative goodwill, or as I saw in one report recently, badwill. As shown on my next slide, PPAs can be incredibly complex, and I set out on screen some of the key considerations we must make. I'll pick up on one or two of these, but by no means all of them. So what intangible assets are identifiable? The actual recognition criteria differ between FRS 102 and IFRS, but in essence, recognition criteria include the materiality of the asset being income generating, its value being measurable, and if the asset is separable and or contract based. Typically, the areas, as I've said, that we get involved with are brand, customer relationships, and technology. But other revaluations that need to occur as part of the PPA process would include property, inventories, and all sorts of other assets and liabilities. So what is the correct methodology to be adopted? Well, particularly in the intangible asset arena, there are so many different types of assets, and there are so many different types of methodologies. We select ours based on the international valuation standards, dependent on the type of asset being generated, but most are built around a discounted cash flow model. So there are some opportunities here. The recognition of intangible assets that may qualify for tax deduction on amortization can be a very strong point. The presentation of a stronger balance sheet for the company with less reliance on goodwill and perhaps more stronger intangible assets such as customer relationships and technology. Or conversely, under FRS 102, there is an opportunity for intangible assets not to be recognised where they might otherwise have been recognised under IFRS 3. However, they do still need to be considered. In my next slide, I start to consider impairment reviews. As Peter mentioned, impairment is the #1 issue that's been identified by the FRC, so it's clearly under the microscope. But I also saw on their list that at #2 was judgments, as most valuations are, and at #10 was fair value measurement. Impairment reviews are necessary where a business identifies indicators of an impairment. This might be as simple as an interest rate increase, which causes the costs of a division to spiral, or it might be the payment of a dividend from a subsidiary up to its parent that eradicate the value of the subsidiary. We have to be careful in this area, and you need to keep your eyes open for these indicators. Again, I've put a definition on screen, which I'll let you read through. But what is the importance of an impairment review? One point raised is asset valuation accuracy, or as valuations aren't always accurate, at least reasonableness. And another point is investor confidence. Often this is the existing shareholder, but it can be potential acquirers, debt funders, and even other stakeholders such as employees, customers, and suppliers. So what is an impairment review? Many businesses have built up certain types of assets on their balance sheet that arise from investment or project expenditure that's been capitalized. Often carrying values are set based on a market transaction at the date of inception. However, if circumstances change, the market value of these investments may decline below the carrying value, even if that carrying value is being amortized. In such circumstances, the standards require the carrying value of the investment or expenditure to be impaired. We must therefore ascertain the market value and or value in use of such assets. So on the next slide, I've set out the steps within the accounting standards. Previous slide now. The first step is we must identify the business's CGUs. These are the cash generating units. Next, we ascertain the fair value and the value in use of each CGU. From these, we can calculate the recoverable value, which is the higher of the above. And hence, if measuring only one suffices, we don't need to measure both. And finally, we recognize or reverse any impairment loss. And now on to my next slide. Again, I put up a number of considerations here. We'll pick up just one at this stage. The most important thing here is to identify the cash generating units. Simplistically, the cash generating unit is a part of the business which has separable cash flows that can be identified and has a separate cost that needs to be assessed. So in my last section, and I apologize, I'm flying through these, I consider share-based valuations. As mentioned by Sam, share schemes and growth shares are becoming more popular in the right circumstances. Again, I've put a definition up on screen, but she's already been through that, so we can move straight on. These are important as they align the interests of employees with those of shareholders, promoting motivation, retention, and drive value growth within your business. They also ensure the better recognition of cost of employing staff than would otherwise be included. And finally, it goes without saying, it's satisfying those auditors again. The steps from IFRS 2 are we have to recognize the need for these, and I'll come back to that shortly. We then ascertain the value of the underlying share. If required, we derive the value of any option. So options obviously are different from shares. And the standard even defines the necessary steps in looking at the option. We must consider things such as the current share price, volatility, dividends, and the risk-free rate. And finally, we release the expected total charge over the expected vesting period. And on my very last slide, I've summarized some of the key conditions again. The only one I'll highlight on this occasion is that the most common error we see is that because there's been no cash transactions, the options have not been accounted for at all. So even if there is nothing changing hands, please get in touch with your usual KR contact and we can discuss it. So in conclusion, thank you for your attention. I'm open to any questions. Please post them through the Ask a Question facility or come back to us through your usual KR contact. But I'll hand back over to Jen now.
Great, thanks so much, Tom. Now you probably realise we've run slightly over on our presentation time, so please do submit your questions as I showed earlier on screen, and if we don't get a chance to answer them today, then we will definitely be coming back to you after the presentation today, and someone will be in touch to make sure your questions are answered. So we are going to run our last poll, which you've already had a preview of, so it'll come back on screen in a moment. So our last poll is, what is your business's main priority over the next 12 months? Is that going to be growing your business, sustaining your business, business survival, acquiring a business, maybe a bit of merger and acquisition, or maybe selling or exit? So we'll just leave that there for a moment whilst that comes through. Be great to hear your views. Growing. Okay, well that's going to please any government that comes in, any party, because that's clearly a need for our economy with some of those tax commitments they've made. But thank you very much, everyone, for giving your responses there. So we've just got a few minutes to answer perhaps one or two questions. But as I say, if we don't answer your questions today, we will certainly be coming back to you after our session. So I'm going to start with a question that's come in for Phil, actually. Phil, this has come in from Mike. Mike has asked, have the full effects of the interest rate rises worked their way through the economy?
Right. Yeah, good question.
Crystal ball.
I suppose the straightforward answer is no. Monetary policy, traditionally takes 18 months to 2 years to work its way through a system. So quite a few businesses and households on fixed rate deals, particularly mortgages, won't have seen the impact of the changes of interest rates, given that the first rises were in late 21 and we saw 14 consecutive meetings of interest rate increases to 5.25% in August. So we've had relative stability, as mentioned earlier in I think it was Mohammed's presentation. And we will have had a year before the next rate change takes place in August this year. So that window is going to work its way through the system. I mean, some individuals may well find themselves, if they negotiated a mortgage rate halfway through the interest rate increases, remortgaging at a similar rate as rates come down towards the end of this year and into the forecast period in 2025 and 2026.
Okay, so keep a watching eye, I think. Thanks very much for those insights, Phil. Peter, I'm just going to move over to you briefly. We've had a question come in from Patrick. Patrick has asked, how do new accounting for leases rules differ in terms of impact between lessee and lessor?
Well, Patrick, the changes I described really impact the lessee, the person who has the right to use the asset. So that's the big change there, is the person who's taking out the lease and how they will now go onto their balance sheet, regardless of whether we treated it previously as an operating lease or finance lease. So the accounting for lessors remains principally unchanged. And it's quite a complicated area in its own right. So it would be an opportunity to check in on the detail with your Creston Reeves contact. But we are talking about the changes to lessees there.
Okay, so lessees is the changes we've been talking about, but if you are a lessor, there's some complexities there that it's worth talking to your advisor about. Thanks very much, Pete. And Tom, just briefly before we have to draw this session to a close, I've got a question from Candy that's come in. She asks, with regards impairment, what represents a reasonable WACC for an AIM-listed company?
Yes, happy to answer that. So WACC is the weighted average cost of capital. It comprises a mix of the cost of debt, that is the return required by the debt investors into a business, and the cost of equity that the shareholders in the business will require. And both of those things will in turn be reflective of those individuals or those corporates' assessment of the risks of the investment in that business. So I'm afraid the answer to that question is it will very much depend. It depends on a number of factors. It depends on the industry that we are in, that the business is in. Certain industries are much more volatile and require much higher rates of return than other industries. It depends on the size of the business, and there's market research out there by various people about the impact of size, looking at it's predominantly based around US listed stocks, but even within listed stocks, there is a very big differential between discount rates applied in cost of equity side of things. And actually, most importantly, it will depend on the debt to equity mix. So if you had a business that's 10% debt funded at, let's say, 8% debt, then it's going to be close to, did I say 10% debt funded? I did. If it's 90% debt funded, it's going to be close to that 8%. Whereas if it's 90% equity funded, it's going to be close to that equity return, which is often much higher. And some businesses have debt returns or debt rates that are much lower than 8%. So all I can say probably is if she sends her details in, then I'll have a look through it in a bit more detail. But that's the overall principle towards it.
Great. Thanks very much, Tom. I'm very conscious we are drawing to a close now. So as I said, if you have any questions that haven't been answered today, you'd like to discuss further, please leave a brief description of these in the pop-up survey at the end of the webinar, and we will be in touch. And we'd be really grateful if you could feed in the very short feedback survey at the end so we can really continue to improve these webinars and events for you. We really value and listen to that feedback. And keep an eye out from us for anything that we might be delivering in terms of updates post-election if there is some sort of fiscal announcement once the election has happened. So whether you're already a client working with us or not, if anything's come out of today you would like to discuss further, please do not hesitate to contact us. We would be really delighted to hear from you. So as we hit 11, that just leaves me to say thank you very much for joining us, and do enjoy the rest of your day.